Right now, sitting in a bank account somewhere, is money that is quietly losing its power, not through theft, not through fraud, but through a mechanism so embedded in the architecture of modern finance that most people will never see it coming until the damage is already done. The rules governing how your savings grow, how interest is calculated, how liquidity is protected, and how your deposits are prioritized in times of systemic stress have been rewritten, not dramatically, not with headlines, but incrementally, technically, and with a precision that only becomes visible when you know exactly what to look for. This is not speculation. This is documented regulatory shift, measurable in basis points, in reserve ratios, in quietly amended federal guidelines that went into effect without a single press conference. To understand what has changed, you first have to understand what the original architecture was designed to do. When deposit insurance frameworks were constructed in the mid-20th century, they were built on a foundational assumption that bank failures would be isolated events, localized collapses that could be absorbed by a centralized insurance mechanism without triggering cascading systemic failure. The science of that assumption was sound for its era. Bank runs were physical events. They required people to show up, stand in lines, demand paper currency. The friction of that physical process created natural delay, and delay gave regulators time to intervene. What nobody fully modeled at that time was the consequence of removing all friction from financial transactions, of building a world where billions of dollars can move between institutions in milliseconds, where a rumor on a social platform at 11 p.m. can trigger a deposit outflow of $20 billion before sunrise. That is not a hypothetical. That is precisely what happened to Silicon Valley Bank in March of 2023, and the regulatory response to that event has quietly restructured the assumptions underlying your savings account in ways that remain almost entirely unexplained to the general public. The core misunderstanding most people carry is this: they believe that because their deposits are insured up to a statutory limit, they are protected from the mechanics of what happens inside the institution holding their money. That belief is functionally outdated. The new liquidity coverage frameworks, updated stress testing requirements, and the evolving treatment of uninsured deposits under resolution planning rules have shifted the risk calculus in ways that matter enormously to individual savers. Under updated guidance, banks are now required to model rapid outflow scenarios with far more aggressive assumptions than before, and the way they hedge against those scenarios directly affects the yield they can offer depositors, the terms under which high-yield accounts are structured, and the conditions under which promotional interest rates can be sustained. When a bank models a 30% deposit outflow in a 48-hour stress window, it must hold correspondingly more high-quality liquid assets, and those assets generate lower returns than the loans and instruments that once funded your interest payments. The hidden scientific principle at work here is one borrowed from systems engineering. It is the concept of redundancy cost. In any resilient system, the components added to prevent catastrophic failure consume resources that would otherwise go toward productive output. A bridge engineered to handle 5 times its expected load uses more steel than one engineered to handle twice its load. That additional steel is not waste, it is the price of survival under extreme conditions. The updated banking resilience requirements are structurally identical in their logic. The system is being reinforced. But reinforcement has a cost, and that cost is being distributed silently across the yield environment that ordinary depositors experience every single day. The average saver does not receive a memo explaining that their 4.5% high-yield account has migrated to 3.8% because the institution's liquidity stress modeling now operates under Basel III endgame parameters. They simply log in one morning and see a lower number, and most of them accept it without question. What makes this moment genuinely critical is not any single rule change. It is the convergence of multiple simultaneous shifts arriving at the same time that real purchasing power is already under sustained pressure. Inflation-adjusted returns on savings deposits in the current environment are, for a significant portion of the market, negative in real terms even when the nominal rate appears competitive. The evidence for this is straightforward and publicly available in Federal Reserve H6 money stock data, in FDIC quarterly banking profiles, and in the published liquidity coverage ratio disclosures of every major financial institution. The architecture of your savings is operating under a new set of physical constraints, and understanding those constraints is not optional. It is the difference between a financial strategy that survives the next decade and one that erodes silently beneath you. The erosion does not announce itself. It arrives the way structural damage arrives in a building, invisibly, incrementally, hidden inside walls where no casual observer thinks to look. And just as a building can appear completely sound from the outside while its load-bearing elements are compromised from within, a savings account can display a positive balance, a competitive rate, and a reassuring insurance label while the real purchasing architecture underneath it is quietly failing its fundamental mission. To survive what is coming in the next phase of this regulatory and monetary transition, you must understand the precise mechanism driving the change. Not at the level of headlines, but at the level of systems, flows, and structural incentives. The mechanism begins with something called interest rate risk-duration mismatch. Banks traditionally profit by borrowing short and lending long. They accept deposits that can be withdrawn on demand, and they deploy that capital into loans and securities with maturities stretching years or decades into the future. The spread between what they pay depositors and what they earn on those longer assets is the engine of their profitability. For decades, this engine ran smoothly because interest rates moved slowly, giving institutions time to adjust their asset portfolios gradually. What the post-2022 rate environment demonstrated with brutal clarity is that when rates move fast, historically fast, for 100 basis points in less than 14 months, that duration mismatch becomes a catastrophic vulnerability. The assets on the long end of the portfolio lose market value in real time. The liabilities on the short end reprice immediately. The gap between them, under sufficient velocity, becomes a solvency event. This is not theory. This is the documented autopsy of multiple regional bank failures, and the regulatory response to those failures is now permanently embedded in the rules governing every institution holding your deposits. What most people fundamentally misunderstand is that the regulatory response, while necessary from a systemic stability perspective, operates in direct tension with depositor yield. The new rules require banks to hold larger buffers of low-yielding liquid assets, to stress test against faster and larger outflow scenarios, and to maintain capital structures that can absorb losses without triggering contagion. Every single one of these requirements consumes margin that would otherwise flow toward deposit interest. The mathematics are not complicated. If an institution must hold 20 cents of every dollar in assets yielding 2% to satisfy liquidity requirements, the remaining 80 cents must generate enough return to cover operating costs, shareholder expectations, and depositor payments. When the cost of regulatory compliance rises, something in that equation must compress, and historically, the variable that compresses first and most silently is the yield paid to ordinary depositors who are not sophisticated enough to negotiate or mobile enough to immediately relocate their capital. The hidden scientific principle operating beneath this entire dynamic is the second law of thermodynamics applied to closed financial systems: entropy. In any system where energy is continuously being redirected toward maintaining structural order, the productive output available to participants at the periphery of that system inexorably declines. Regulatory capital requirements are, in thermodynamic terms, the maintenance energy of the banking system. They keep the structure from collapsing. But they do not generate new value, they consume it. And the participants least equipped to offset that consumption through alternative strategies, higher income, or sophisticated asset reallocation are precisely the ordinary savers who depend most heavily on deposit yields to protect their accumulated capital from inflationary decay. The evidence supporting this analysis is measurable and documented. Federal Reserve data shows that the transmission of policy rate increases to deposit yields in the 2022 to 2024 tightening cycle was significantly slower and more incomplete than in previous cycles. Banks captured the benefit of higher rates on their asset side far faster than they passed those benefits to depositors. The differential, sometimes called the deposit beta, was historically low, meaning depositors received a smaller fraction of the rate increase than at any comparable point in modern monetary history. This was not accidental. It was the direct consequence of institutions operating under tighter liquidity constraints, higher compliance costs, and shareholder pressure that consistently prioritized margin preservation over depositor compensation. The system was working exactly as its incentive architecture dictated, and ordinary savers paid the difference without ever being informed that a difference existed. Understanding this is not enough on its own. Knowledge without adaptive strategy is simply informed helplessness. The survival implication of everything documented here is precise and actionable. Your savings architecture must now be evaluated not against nominal yield, but against real yield adjusted for inflation, regulatory risk, and the structural trajectory of the institution holding your capital. The rules have changed. The game has changed. And the only rational response is to change with them, deliberately, analytically, and without delay. The next phase of this transition is already underway, and it will separate those who adapted from those who simply waited for someone to explain it to them.